Hi folks, it's Aidan CryptoBurb speaking. Welcome to today's Friday webinar. What a beautiful, shiny day here today in Portugal, and what an amazing day in the markets. The Bitcoin has started to actually follow through higher, building up some upwards momentum right behind the Ethereum breakout. Well, are we heading right and stepping into the new bull market cycle? It does seem so. Let's have a look into the charts right in a second. Welcome. Let me know, everybody, how you guys are doing today. Great greetings and best love coming to you from Ericeira. This is a beautiful place right at the ocean in near Lisbon in Portugal. I've been living here for quite some time, and the weather is always beautiful. And I gotta be honest, when the markets pump, when the markets finally commence, the entire market move up, the ascent. This is looking even better. This is no lie. The market when the market pumps, everybody smiles. When the market pumps, everybody makes money. This is way better feeling and way better situation and environment than the entire 2022 bear market. And the reason for the market to build up and accrue lots of good movements up to the upside in this year is definitely has been appearing throughout the years, because the pre-election years is a year that happens pre-elections, before the elections, not in the election year, which is going to be the next one, but comes right after the midterms. The midterms have historically always been about the bear markets, about this overall kind of like a sideways period. It definitely was, was everything but bull. Here on the pre-election years, we get the results of the most spectacular pumps within the entire presidential cycle. So the entire presidential market cycle typically kind of like leads the way that the stocks behave. Kind of like comes depending. There are some seasonal patterns that have accrued and basically appeared over many decades of the history, so that there is a certain seasonal pattern within the presidential cycle. And it does seem that after the bearish midterms, typically you will get a very consistently bullish and the most bullish year out of the entire 4-year market cycle for the presidential cycle to be in 2023 in this case. So there's a lot of seasonal reasons for the market to go up this year. There's a lot of reasons for the market to go up also from the technical standpoint, because so many markets have been actually just dragged to the downside and basically underperforming anything that is defensive, anything that was a safe bet. And right now, in the first couple of days in January, we're looking at a very strong upward rally. And well, as January goes, so goes the year. This is a January barometer, and it's very important because, well, this is a really incredible case. Let me actually just show you the chart. So the January barometer, this is a freshly taken chart actually of the S&P 500 sectors from this consumer discretionary communication services on top towards the actual defensive sectors such as staples or healthcare. So you can tell that for the entirety of 2022, those bottom charts, those bottom curves, as in the actual healthcare sector, the consumer staples, or utilities, so very defensive stocks that tend to pay out, low yields, but tend to be very stable and very well established. This is a safe haven for many traders who actually tend to prefer, those types of assets on the risk-off side of the market whenever the times are not good. And you can tell the correlation has inversed, the correlation has shifted, the market has shifted technically from the inside. The preference from the market traders, participants, actually is now flipped by 180 degrees, and it's now turned towards risk on. And this is very well respected and reflected in the way that the first days of January basically are seen on the performance chart within the S&P 500 sectors, led by the communication services, which is probably one of the most risk-on factors, risk-on markets, followed right behind by the real estate, which is also naturally inflation sensitive, interest rate sensitive market. Whenever interest rates are high, the market on the real estate side kind of like tends to suffer because it withdraws the capital, makes the cost of borrowing too high to actually just go and build up, right? Hence, new housing permits decrease, basic materials also kind of like, just tend to follow right behind right now on the improvement side, where typically the basic materials and the entire industry starts collapsing with the housing markets as well. So it's very good and positive that we're looking at a very strong recovery and a very first push towards the first, towards the half of the January already. And as January goes, so goes the year. And there is a lot of reasons for it. And it's not just some kind of like a gimmick, one trick pony. We're talking about some insanely rich historical record on the map. And here's, let me quote it. The incredible January barometer device 1972, only 12 significant errors in the 72 years. This is basically an 83.3% accuracy ratio. So 83.3% accuracy ratio means that if you want to trade or counter trade it, trade against it, just oppose it, well, then you have to have a really good reason for it, because if more than 8 times out of 10, you get to see the following results, that if so, as January goes, so goes the entire year. If January ends up positive, the year is positive. If January ends up negative, then only 16-17% of the time in the history over since 72 years, 1950, right? This is a long journey, long history, and a very, very solid and stable track record. So I would argue that those market outlooks, pointing to the upside for the risk on assets, this is definitely something very good and promising, I would argue, for many traders, including myself, for trend followers who are actually have been waiting for the majority of the most of the 2022 in cash. Trend following is a very good concept in technical analysis, which is something that I actually promote there's a lot of reason for it, right? Trend following is an actual conservatism approach in trading. In fact, all the technical indicators are somewhat conservative, because they tend to promote, especially the trend following, they tend to promote that only you get to enter the market when there is a signal, which means that when there is not a signal, which by definition is for the most of the time, then you're supposed to be out of the market. You're not supposed to be in the market, which means that it promotes cash, it promotes sideline. So it promotes safety. This is why we use technical analysis. This is why we use technical analysis as a risk control measures. And well, in all honesty, it works, right? Especially at times like that when the longer tails develop in the market. And this is something extremely good. Now, also followed by a real good looking pump, on the Dow Jones Industrials, as the upper half of the chart kind of like shows. The bottom curve is actually for the Dow Jones Transportation Average. And you can tell that both are moving in alignment, right? As opposed to the actual case when we had this misalignment, this bearish divergence on top, when the ascending high sequence was popping up on the Dow Jones Industrials, and the descending highs, declining highs, lower highs in sequence were coming onto transportation. It kind of like flashed and alerted a little bit of a bearish divergence, which shows that the prior lasting trend was not sustainable anymore, right? And boom, we got this nice correction to the downside as the mean reversion. The mean reversion was a pullback on the price side, on the Dow Jones Industrial side, as it pulls back to its 200-day average. And you can tell that the angle has shifted. The bear market slope, the bear market angle shifted to the more neutral one, right? So we are right now out of the bear market, and we're somewhat in an arguable bull market as a new cycle comes in, right? And the new cycle comes in not just because I say so, not just because this one tiny little chart just shows this, but in fact, it is very well reflected, like I mentioned, in the seasonality chart or the actual performance chart within the S&P 500 sectors. Because if the cyclical stocks, which are risk sensitive, risk barometers, if those tend to pump heavily, and those pump move aligned with cycles, move up whenever the market cycle is basically upwards oriented, and move down whenever the market cycle is downwards oriented, then this is a sign of a new bull market. That's what it seems. That's what it looks like. Whenever there is a strong continuous increase, and you can tell there's been a lot of continuity, there is not so much like in very most of the cases, except for the underperformance, which is the below the below zero returns, basically the negative returns, are only given to the defensive stocks. So this is a completely opposite situation to what was happening for the entirety of the 2022. We are looking at an inverse relationship, at an inverse market shift. The market has shifted, the market has inversed specifically and technically. This is the beauty of technical analysis. It tells you what's happening inside of the market. You can have a look, and with the technical toolkit, you can literally just examine what is going on inside the financial market, not outside it. Fundamental analysis kind of like just approaches this as a one market, as a unit. It doesn't kind of like let you slip and have look inside what's going on specifically technically between the traders on the auction theory and so on. Instead, it looks as the market, how it connects with the macroeconomic side of the things. Here, we're looking at a beautiful case on the application of the technical toolkit, which is really helpful because it tells you, okay, if the risk-on environment is basically back on the table, then just maybe, and it promotes this more investment side of the things and investment activity rather than investment passivity, right? This passive side of the 2022 seems to be gone. Let's have a look at the next chart. And the next chart is XLE, right? The next XLE, which stands for the energy prices, the market, the S&P 500 sector for the energy stocks, which is in a continued bull market, right? You can tell that by the way that since 2022, basically, since there was a breakout in the late 2020, the 2021 kicked off and continued through 2022 with a very steady and healthy and well-framed, well-defined 200-day moving average ascent, which represents the primary trend, the bull market continuing upwards, and it still continues so, right? So the way it tells me, of course, there's been a little bit of a sign of exhaustion, right? As I was last week, I was mentioning about this concept of a failed pattern on top, this rounded top, which basically, again, just kind of like invalidates potentially, unless proven wrong, invalidates this strong increase for the continued upwards. Because, well, typically what happens when you get to see the resistance and the market breaks to the upside, but it fails to hold it and continue higher, this basically means that there is the resistance, which is basically reinforce additional. That's what I mean. If you have a range that is well defined over the time and it bounces back and forth between the levels, between the frames, and you can tell that there's an overshoot basically, and it hides back inside a range, then this is classified as a false breakout, as a fake breakout, fake out, specialist breakout, whipsaw, whatever you name that. The truth is that failed breakouts tend to perform better in the opposite direction. So when it fails a break to the upside, then it performs better into the downside and is likely to extend and move not only towards the lows of the range, but also further beyond. And that's what it seems, right? So I would argue that unless this top failure pattern is invalidated, and there was a nice rounded top, kind of like a saucer, or even some people could just argue with some perfectly shaped, head and shoulders on some more lower scale. However, to me, it looks like a really nice example of a saucer top cap pattern, whatever you name that, clear distribution, which was followed by a nice technical breakout to the downside, which found a support towards the mean reversion levels at around 80, 81, 82. For the XLE, this was the area of support. And even though we had a little bit of this kind of like a ascending channel or something that I would have framed before as the bear flag, this bear flag pattern, basically, which is a continuation pattern and signal in the move somewhere and the measured move to the downside, I would argue it got invalidated. And this tells me that, well, unless we start aggressively trending lower, then I would argue that the chances are that we may commence and basically reinforce this 200-day ascent, which is the dominant trend for the market to go up and higher, right? So if the invalidation comes in of the bearish pattern, of the bearish flag, of the ascending channel, following the breakdown, then I would argue it may take us and elevate it even higher. What it means for the risk, risk on assets, and what it means for the overall financial markets is, well, definitely not something that is the most preferable. I would say that this is a recessive indicator, if you will, still, because it tells me that the high stock market prices for the energy sector, this definitely defines high market prices for the energy as well, which is definitely inflationary, right? High energy prices is typically what leads to recession. in the end, and even though some people, academically would dispute whether the recession is there or whether it's not, of course, we see tons of leading indicators such as new market housing pyramids just basically declining heavily. Of course, the interest rate spread, which is very, very aggressive and recessive, recessionary. Besides, we're looking definitely at tons of reasons like the S&P 500, which has already reversed, but it still feels this recessive theme, I would argue, right? Because stock market prices tend to lead the economy cycles, the business cycles, right? So whenever the bull market comes in, it can last 6 to 9 months before the economy starts to catch up, right? So the economy is yet to price as a leading indicator versus the S&P 500. It's yet to start pricing in and embodying this entire bearish destructive effect and impact of the bear market of 2022, of the midterms. So that's how it looks. So we're really looking at a lot of recessionary signals, and the conference board leading economic index is definitely flashing negative impacts. It's flashing recession, and what it means for the recession. Recession is a good time for investments more often than not, right? It's bad time for the businesses, because those businesses that kind of like run out of their reserves, run out of money, run out of cash, they go extinct, right? The other go acquired with an M&A process, or basically they just go vanished. And that's not good for the business. However, because the stock market cycle leads the economy by 6 to 9 months, typically when this business capitulates, when it falls into depression, when it falls actually into a proper recession and a very deep full recession, this is when the bear market, this is where not only the bear market has ended a long time ago, but the stock market are already in fatter. So this is the chart I was talking about, right? The orange one is actually the financial market cycle, which is the stocks, which is the risk on assets such as technology, consumer discretionary, industrials, communication services, even materials, right? However, those four are typically the stock market cyclical stocks, if you will, and all of those four are basically here leading, right, with the communication services on top. So those are very interest rate sensitive stocks, and if the traders are pricing in, and they are always pricing in the prospect of future market earnings, right, future market earnings or future market returns, well, it does reflect that the future is expected by the traders to be positive, and this may prove be proven as a self-fulfilling prophecy, as the stock market cycle leads the economic cycle. Like I said, so the technology, consumer communication services, discretionary, consumer discretionary, industrials, those are all leading right now. This is a very powerful setup, and it tells me that if those start to perform well, then we are, well, arguably somewhere over here. Right, the stock market has bottomed more likely than not within October. We can see that in the Dow Jones Industrials. Most of the stocks literally bottomed in October last year, after a very long year of a bear market. So it is a positive note, right? And we get to know that if the stock market cycle leads the economy into recession, then it also can lead it out of the recession itself. So if you look at it this way, like I said, if we've got already the stock market bottom, and it does seem so in October last year, then it takes about 6 to 9 months until it gets not only to start lifting the economy, and so that the economy stops shrinking, gets out of the recession and starts expanding again, but it also tells me that until that happens, the stock market will have already been in a very well-defined bull market, and that's what it seems to be so much better and so much more. And it's going to be even more and better reinforced when we get to see the breakout of 35,000 points for Dow Jones Industrials. And well, the only issue, the only point that I would say and suggest you get caution about is the high energy prices, is the high energy stock prices, right? Because if they are high, they continue to move inside a bull market, and this is still recessionary, this is still recessive. It's still not letting the full unleashed bull to come up, right? So only if the energy stocks, if the energy market starts curving down and basically just again fails, this confirms this top pattern and kind of like follows lower, then arguably this is what may eventually prove and empower, reinforce the bull market cycle for the risk and cyclical stocks. So I would argue that as long as the stock market prices for the energy sector are high, and it kind of like either just move sideways in the high area after the year, 2 years of very strong and very, very persistent inclines, then there is still, this I don't want to say neutralization or annihilation, but there is still a lot of headwind, right? It's posing a lot of headwind for the risk assets and cyclical stocks. We don't want this. And this is the interest rate spread that I was talking about, right? The interest rate spread, which is basically the 10 years minus 2 years. And it tells me that the 2 years are definitely yielding much better than the 10 years, right? This is why the disparity index is kind of like negative there. And as long as it is, this typically leads to recession, right? This is a very recessive indicator because it shows a lot of disbalance and a trouble to the security market, to the securities, to the bonds, and to the entire economy as a whole, right? Because the main utility of the bonds is to be able to reflect the monetary policy, so that the Fed, if they want to kind of like go and reduce their balance sheet, they sell off their securities. They sell if they are allowed to legally sell the now security bonds, the treasuries, just like 2 years or the 10 years, and by doing so, they lower the price of the bonds, and as a result, through the inverse correlation, or should I say inverse relationship with the yields, the drop in the bond prices inclines the yields, and this disparity on the interest rate spread on the yield curve, basically, if you will, is showing an inversion, right? It's showing a negative and definitely unfavorable situation, because it often leads to recession. You can tell that there's been an amazing track record. Every time the recession came in history, it had always had the interest rate spread on the negative side, right? So it is a leading indicator, basically with 100% accuracy, because each and every single recession in the history came prejudiced and pre-informed, preceded by the interest rate spread going into negative zone, known as the yield curve inversion. So this is definitely not something favorable. This is not something that you want to get much of in the economy. Otherwise, you get to see a recession. So how does it all connect, right? Because this is supposed to be telling you how the entire Bitcoin pump has come through, right? You won't be able to understand how Bitcoin behaves without understanding the entire context and the context of the markets. Not anymore. Not anymore. Maybe in the past, when Bitcoin was not so strongly correlated with the S&P 500, with the other markets, because it was small. Right now, it's way more mature. It's way more and way better established, right, within this entire institutional world. And because of that, there's a lot of money managers, there's a lot of institutions, a lot of funds which are tracking Bitcoin as an actual risk appetite barometer, that are tracking Bitcoin market as a cryptocurrency representative, and it's become an asset class. It's become a part of the different financial market, right, group. So it's very important to track Bitcoin in combination and instead with the other markets. That's exactly why I'm trying to show you this kind of like a little bit of a top-down analysis, so that you can understand what's going on inside, outside of crypto and inside of the overall financial market cycle. So it does seem that stocks are heading into a new bull market. You can tell that there has been a really nice chart also that I displayed last week, I believe. Consumer discretionary relative strength ratio of the two securities prices: consumer discretionary, which is risk on representative, and consumer staples, which is risk off. So after bottoming at the start of the 2023, or that's the way I put it, the relative strength ratio actually just bounced back sharply and aggressively, and is right now at the relative support, which otherwise once lost, led to a massive decline. So I would argue that within this well-defined downwards trend on the 200-day basis, it's clear that this is definitely far from the full bullish unleashed. The consumer staples are still strong. There is still a lot of defense in the market. The market is freshly born, right? The market is the newborn market cycle. The new cycle has started, but it seems that there's a lot of headwinds also for this, like I said, for the reminders of the defensive players, defensive sectors such as consumer staples, healthcare, or utilities, and high energy prices. As long as those are kind of like, again, just contradicting this entire cyclical assets to go up, it's going to be posing a lot of barrier and a lot of headwinds. But it means that probably 2023, knowing that the preliminary, the pre-election years are typically the best performing ones, well, this may be a very good signal that 2023 is going to be about recovery, that 2023 is going to be about very sharp recovery and changing the market shifts, shifting the market inside of it, right? Technically, between the traders, from the risk off to the risk on. And I want to see the ratio of the XLY versus XLP to go and ascend towards 2.6 above its 200-day average. And when this happens, this tells me that this is a very, very strong signal and powerful insight, showing you that the risk on is back above its long-term trend and it's back outside the well-defined bearish frames of 2022. Hope it makes sense to you guys. Please let me know how you are taking this webinar so far. If you're watching that on YouTube, make sure you actually hit the like button. Make sure you stay notified with the bells on. So hit the bells on also so that you get tuned in anytime we release something new on our YouTube. And 2023, we're planning to actually release many of those amazing videos that are going to be nothing but pure value for you in very well best presented forms that you can ever imagine. So that's the best challenge for 2023. I want to get you guys with my team. And we're going to be doing that in order for you to stay protected, not to get and fall for some scam messages, for impersonators. This is the only channel that we have on YouTube, so make sure you stay subscribed. Make sure you hit the notification bells as well, and drop some nice comments. Hit the like button as well, because we are right about to discuss Bitcoin. So this is a long-term chart for the BLX. If we want to go even further from the very first price origin history, you can tell that it looks. There is, of course, low track record, that this is low sample. We've only got the, four full market cycles as the bull market and the bear market, which represents the entire cycle before. So the sample of 4 data is not necessarily the strongest one, right? Compared with 126 years of data for the S&P 500, right? Or for the Dow Jones, I should say. So this is nothing compared to Dow Jones, right? Which definitely reinforces a lot of trending environment and nature. However, there is a lot of reasons for why you want to observe Bitcoin from the macro perspective as well, because there is a very well-defined upwards trend, inclining overall, right? So this is a very interesting concept that we are likely looking at the potential break towards the 5th bull market cycle. Right, it started with the 2010 first listing of the Bitcoin on the exchange in 2010 in June, if I remember correctly. Then it, of course, just came up to the $31, I think, in 2011, dropping towards 1.98 at the bottom of 2011. Also, somewhere closer to the end of the year, towards the end of the year, like December, January, November, December, January. Those are typical reversal months. So seasonally, Bitcoin likes to reverse and extend the rally from December to January. That's what it seems to be the case right now. And this was the case in the past, and this may be the case, well, right now, I would argue. So having charts like that, right, where we're opposing, this 200-day trend, which is represented by the black curve, this tells me that there's a lot of reason that if we break it to the upside, then every time we broke the 200-day trend after the bear market decline, in still this declining regime, right, on the descending 200-day average, then if you have a look, right, then let's just note it, declining 200-day trend, representing the primary bear market. So every time we broke to the upside, right, after the year of declines, after the bear market, this has sparked always the new bull market. Even though there was a lot of chop, right, there was a lot of sideways, so it doesn't necessarily mean that if the bear market is kind of like here and we are about to break this nice 200-day trend, right, then it doesn't guarantee that it's immediately going to shoot up and just go like there's no tomorrow, but it tells that every time there was a positive breakout to the upside over the 200-day trend, which had represented the primary bear market in the declining mode, then this has sparked a new bull market. So this is something worth considering. This may be worth thinking of if you are as successful, if you want to be a successful Bitcoin trader. So this is a Bitcoin chart on the daily chart. On a daily time frame, 200-day trend is also the same line that you saw on the BLX chart here before. And Bitcoin is right now approaching this overhead resistance, this price barrier. And typically when there is a first encounter of a price barrier, of a technical resistance, and right now this 200-day trend represents a lot of fair value, a lot of eyes are looking into it. A lot of traders are assessing and evaluating the 200-day mean as the fair price point for Bitcoin. Then it may mean that, well, technically there is initial resistance to be met. There is an initial price barrier, right? As lots of ask-calls orders are actually clustering and aggregating in one area around 19,500. So at first, there is a chance we may actually see some opposing force, some headwinds, instead of just rushing an immediate shoot up. However, it doesn't mean that it cannot just get consumed somehow, because for every ask there is going to be a bid. For every bid there is going to be an ask eventually, right? This is within the free market what's going on, and the financial markets of the cryptocurrencies for Bitcoin, it works like that as well. So here at first, technically we may expect, it's fair to expect a little bit of a price overhead resistance, of a price barrier at first, that once diminished, once battled, once fought and won over, I would argue it may take us even further. And this is, if that happens, this would be very, very positive, right? Entire 2022 was about nothing but declines. This was a very steady, well-defined bear market as it took Bitcoin from the peak of $69,000 to the low at 15,500 for the 79% of the drawdown totally. It's definitely not, well, historically you would get to see the Bitcoin drawdowns peak to trough towards 80-85%. 85, maybe 90%, somewhere between 80 and 90%. So 79 is close enough, it's fair enough. So I would argue that even though there are chances that historically the pattern tells you that there might be a little bit of more downside, who knows? Perhaps Russia-Ukraine war just escalates and there's a lot of reason for the market to go back deep inside the average. Who knows, right? We don't get to know the future. However, technically, and this is the only way we can just tell that, technical analysis is not going to tell you when the war escalates. It's not going to tell you when the asteroid crashes into Earth, right? It's not going to tell you when the dinosaurs go extinct. Instead, it tells you what's going on and cooking inside of the market as traders are pricing in and reflecting their behaviors, their emotional decisions in the way that the price moves. And the price reflects their decision. The price reflects their behavioral biases, very often showing that if there is a lot of exponential rally right now, and it hasn't been present for quite a while, I would argue, then it's definitely something to consider, something worth considering. You didn't get much of this nice upward sloping, kind of like accelerating movement, right? Those are not steady movements as you would see in the efficient markets. Those are full of a lot of inefficiencies as traders start feeling the regret bias, start feeling their cognitive dissonance, which is typically felt in the greatest way when the market freshly reverses, right? That's where a lot of new views with the market reversing conflict with our previously held views, because they belonged to the bear market, right? So if this is like a strong push, then your mind will make you compartmentalized, which is what a difficult word, difficult to pronounce for a non-English speaker, native speaker like myself. So this mental compartmentalization is going to help you diminish the significance and the weight of this new information to be processed, and it filters it away, kind of like ignores it, right? So for the cognitive dissonance, you either compartmentalize this or simply ignore. So if the cognitive dissonance is the biggest, at the greatest amount of it comes right at the reversals, then I would argue that Bitcoin traders, if there is enough of a push over 200-day trend, they soon start feeling the regret bias and additionally empowering the rally to the upside, right? Because if you feel regret, if you feel the fear of missing out, this definitely pushes you, as the loss aversion, it pushes you to make some irrational moves, right? Irrational moves which empower this positive feedback and make those trends kind of like, instead of look like that efficiently in a stairway case, it makes you look like this, where it goes, the further it goes, the faster it grows, right? This is the this is the ideal case for the trend. And when something like that happens, when the more of those kind of like vertical rallies you see, the more empowered the trend is technically to go up, as the momentum principle starts to work very well. So that's the case, right? I want to see for the continued bull market, for the first breakout into a new bull market after a year long of a bear market. I want to see basically market, reverse over the 200-day trend. And if that happens, if the 200-day trend is really broken and Bitcoin pushes through and establishes, the trending even above $21,000 above the previous highs of November, then I would argue that this is classified as the very first signal of a new bull market. So that's what it looks, that's what it seems to me this way, right? So this is how the alert has got triggered. Also for this is the alert that you want to get triggered also for the new bull market cycle, and that's what has triggered already for Ethereum. Because if you have a look at the Ethereum chart, then what you're going to have a look right on the left side is not only that the 200-day trend has been already broken, right? It's also kind of like lifting for the first time in a while. It started lifting for the first time since the bear market started. Basically, you can see that it's lifting up, it's ascending. So the 200-day trend has started ascending. This is not something that I would argue you would see in the bear market. Instead, the bear market brought nothing but heavy declines ever since it started, right? So here, the first sign of strength on the technical matter and the technical standpoint is definitely not only positive, it's not only strong, but it's also a very rare occurrence, typically signaling a strong bull market, which is why I would think that Ethereum leading the way of Bitcoin out of the bear market, may push eventual Bitcoin traders outside of the 200-day trend. And if that happens, it may get enough of a rally power and steam to push and overtake $21,000 area. And if that happens, then this is positive. And if that happens, I would argue that the January barometer saying that as January goes, so goes the year should be about this strong pre-election year where the crypto is regaining its true glow. That's what it seems to me, guys. And hopefully it's going to come and materialize soon as well, because we get to see the typical bullish seasonal pattern from April towards May, and there where it goes, sell May and go away towards more lazy, quarter three as June through September, finished off with a strong ride towards the 2023. And that's what it kind of like paints the picture like that, the vivid picture. I've been long in Bitcoin ever since the bull node on the barometer pro had started, which was triggered at around 16,900. So 16,900s, or should I say, which was the actual position? Let me check. Let me verify. What was the entry? He was an entry confirmation with my trade acquired for 56. What was it? 58. Jesus Christ! What is the number? It's $580,000. That was the six-figure quote. Sorry, I couldn't burn these yet. My eyes are not the same anymore. With the entry, on average entry of 16,920. Right now, the first initial stop loss at 16,439. Right now, so 16,920. Was the entry right now. Or right now, we are, of course, when the stop loss defined at 18,506 by the barometer pro. So I keep adjusting. This is a very well-defined exponential trail and tail to the upside as the market is really ascending aggressively and all up and above the locally met December resistance at 18,500. So this is definitely positive. This is definitely strong and sharp. The bull market signal on the 200-day curve is yet to be confirmed as it breaches and may breach towards $20,000. If it does so, perhaps may get enough steam to continue higher above 21,500s, like I said. Otherwise, the early medium-term time frame, the 12-hour time frame, which is the one that I trade on a trend following basis on the position trades with the barometer pro, which is the tool that I use here for the trend breakouts. This signaled this entry for me at around 16,900s, and that's where it stayed so far. So the position is heavily in profit. It's very good. Hopefully it's going to extend higher. I'll just keep trading the trend for as long as it lasts. I'm not going to cut it anywhere long. This is the very principle of the trend following. Not catch your trends, not catch your positions early, because when the trend following develops, you've waited for about 80% of the time. That's what I did. 80% of the time the market was choppy. 70-80% of the time the market was choppy. If it wasn't choppy and it was declining in 2022, which was the prominent dominant trend, and right now the primary dominant trend just maybe is going to get finally lifted off to the upside as it ascends above $20,000. That's the type of the reaction that I want to see. A little bit of a first resistance price barrier to be expected at 19,500s. If it does so, then my job as a trend follower is to keep it going, to keep adjusting the stop losses higher. And finally, maybe this main breakout comes in, and when it does, then you want to be aware of what's going on when it happens, right? Because when it happens, where was this chart? Let me find it actually. Let me show you this chart. This is going to be a nice one. Should be this one. Exactly, right? So once in a while, as a trend follower, you get to see lots of chops, right? Lots of choppy situation. However, when you finally get this, right, then it may get you one signal for an entire bull market almost, right? And you can kind of like just keep going. That's the nature of the trends. When the market oscillates 80% of the time it's sideways and it finally breaks above the main resistance, it kind of like tends to persist through higher highs and higher lows, and it finally gets this on pace with the full momentum. That's where the fireworks start. That's when the things accelerate. That's where the biggest amount of money is made, and that's what you need to keep adjusting. If the stop loss gets you out of the market, you need to re-enter as soon as possible, not to miss on the fat tail, not to miss on this exceptionally long run in one direction. This is the type of reaction that I want to see everybody, and in order to help you there, I decided to launch some time ago the free calls only market service, right? So some of you may know that I've been leading and running the Bourbon since 2017. It's the 6th year right now of our operations, and for the first time ever, you can now get our basic premium calls only service free of any charge. It has always been paid before. It had always been paid, and right now, I know that lots of traders suffered from the FTX, from Luna, from the bear market. There are not many winners who are left. If you are here, congratulations. Give yourself a round of applause because you deserve that. You've survived the bear market. And to help you rebuild all your portfolio, to help you regain all the market insights that you want not to miss out on the next bull market, I'm giving to you the calls for free. And the only thing you have to do is to go to thebourboners.com/COBB. COBB is the slash, right? thebourboners.com/COBB. When it does so, when I click on it, and it's pinned under my Twitter, right? It's pinned under my Twitter account. Then if you go under thebourboners.com/COBB, then you're going to get instructions on how to acquire the product that is on the early basis worth even $14.28, more than almost $1,500, more than $1,500, a year. You can get it even for free with our partnership Bybit. And the only thing is just you need to follow a very simple set of instructions defined by our Bybit and the special conditions that are going to entitle you to free calls only package. That's it. Go for it. Go to thebourboners.com/COBB, thebourboners.com/COBB, and unlock your free premium signals for the first time ever. Let's get you pumped and ready for the next bull market. That's all I've got for you right now. God bless you all. See you around. Bye-bye.